Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing up to 90% and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 20% off, you can use code A1T20. Again, that will be 20% off any of their challenges you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show. Hey guys. All right, everybody, welcome back to another A1 Trading live stream. Thank you for being here. Taking a look at what's happening in the markets this morning. We have stocks in the red and we have gold and silver in the green. In fact, actually all 5 of our commodities here, natural gas, copper, silver, gold, and oil, all up on the day. Bitcoin's down 2%. Ethereum's down 1.5%. Good old Dogecoin down 4%. Bonds down slightly here this morning with yields creeping up. That signals that the dollar index is actually up today. So we've got some interesting, well, modestly up. It's just holding up. Interesting start to the day, that's for sure. You've got, there was some geopolitical headlines, I believe, out of the Middle East, something about ceasefire breakdowns or something of the like, which I believe is part of the main reason. Gold continues to rip higher. I put out a video yesterday, and I am not saying this to dog anybody who is bearish on gold, but I made a video about gold yesterday, and I mentioned that I think that it could continue to move higher, and I've been saying that for a while on the channel. I've been bullish on it for a few years. I have not perfectly timed the whole thing or anything like that, but I am in a trade right now and continue to trail stops on this one. And somebody commented on my video and they said, trust me, gold will not cross, I think it was 3,027. Somebody made that comment. They said it will not cross that. And it's crossing that. And I don't say that to say, haha, you idiot. See, gold did that and you thought it wasn't going to do it. Nobody knows with certainty what the market's going to do. But that's the point I wanted to get to. If you're somebody who says right now, you're thinking there is no way that gold does a move right up to 3,100, you might be right. Like you might be right that it's going to go down. But you saying any absolute terms in your trading, I talk about this frequently, practice removing those from your dictionary as a trader. Once you start accepting, you don't fully know. You don't know with any decisiveness or with any certainty what a market can or cannot do. Things start to change in a positive way. Many traders make this mistake. I made this mistake thinking like, okay, gold can't keep going like this. That thinking is like walking the plank on a pirate ship. Okay, you are setting yourself up for failure when you say something like that, when you think something like that. So don't use those types of words. It's really dangerous. You know, it's like talking bad about yourself. If you're talking bad about yourself, you're kind of like, you know, you're self-fulfilling your own destiny, if you will. With trading, if you say things like, oh, gold can't keep going, it's got to go. Look, gold might pull back. Like we might see a downside move, but there is no certainty to that. And the second you understand that, you realize, oh, that's why we use stop losses. That's why we manage risk. That's why we don't go all in on trades, is because all we can do as traders is make educated guesses on a back-tested system with proper risk management. That is all we can do. If you could write that down and just stare at it every time you're about to place a trade, you'd probably be better off. I know I would have been. Man, that would have saved me a lot of money and a lot of time. You don't know anything for certainty. You might think, actually, I think gold is going to keep going like I do. Let me give you my example. I think gold is going to keep going. But in 24 hours, I could look like an idiot for saying that. Gold could drop so hard. we could be back down under 3,000 by tomorrow afternoon. Speaking of which, you have Putin and Trump talking about Ukraine and the situation there. If there is a positive resolution, gold's going to drop hard. Maybe not this hard, but maybe. That's the point. You can't rule this out. And I say this so frequently because, again, it is number one rookie mistake is thinking, you have some kind of perfect ability to call the market. That is like the first mistake that new traders make. They think they're hot shots, that they can call the market perfectly, or that they even believe that the professionals do that when they do not. It's educated guessing and putting odds in your favor through a back-tested system and taking small bets per trade so that when you're wrong, you don't get crushed. That's it. That's trading profitability. Like, it's not, oh, I have a crystal ball. Look at this. Maverick teasing us. Gold's going to hit 10K. I just saw it on my crystal ball. That's funny. So, just something to think about. Just internalize that today. I hope that you take that with you. Because again, I see that comment so frequently on my YouTube channel. People saying, oh, gold has to do this, or, dollar's going to do this. And it's like, maybe it does, but your absolute terminology is really dangerous because that's how you blow accounts. Because if you say to yourself, the dollar index has to go higher from here and gold has to go lower from here, like it's going to happen. If that's the way you set yourself up, when the dollar moves against you, like you might be right this time, but the next time, let's say you're not right and the dollar flops and what's going to happen? You might blow your account. That's the idea. So anyways, dollar index continues to put in some lower lows, lower highs. We are still kind of just sitting in consolidation around this 103.5 level. Let's see if this level can break. You have a Fed meeting tomorrow. Well, today and tomorrow, the Fed is meeting. And tomorrow we get the dot plot, which I'm very, very curious. I don't know about you guys, but that is what I'm most looking for this week, is to see the Fed's dot plot. The dot plot gives, it's, as the name entails, a dot projection of where Fed officials see interest rates likely to be in the coming months and years. And the reason that's so powerful is that right now the market kind of thinks, in fact, let's pull it up. Let's see what the market is kind of projecting. You can look at the market's projections in a couple easy ways. You could look at the FedWatch tool, or you could just pull up yields, right? Yields have been recently suggesting, and yields are U.S. Treasury yields. This is what they yield on bonds, right? So that's been coming down. So that suggested, okay, we might actually get some rate cuts this year. When it was up here, it was looking like no rate cuts, right? Inflation was hot. Now we see inflation cooling a little bit, and we see the economy softening up a little bit. Not entering a recession. That's what, headlines will sell to you. They'll say, oh, we're going into an imminent recession. Maybe we are, but I don't think we have that data yet. Then we can take a look at the dot or the thing here. You can see there is a 99% chance that we're not going to change anything on the interest rates tomorrow. So we're not looking at tomorrow. Tomorrow, rate cut, not happening. If it does happen, something seriously would freak out the market, because people will be like, why are you cutting rates? Is something wrong? So they're not going to cut rates tomorrow. That is almost a certainty. But then we start getting interesting. Things start to get interesting once you look into May of next, or the next Fed meeting, May 7th, right? Now you got an 80% chance that they don't cut, but a 20% chance that they do cut. Again, the data between now and then will determine what happens. NFP reports, CPI reports, services PMIs, unemployment claims. These data points are what the Fed decide what to do. That's why fundamentals matter, and why it drives me crazy when people say they don't. It's what the Fed uses to decide if money's flowing in or out of the system. At the end of the day, the Fed is the money printer. They're either printing money into the system or taking money out of the system. And if money's going into the system, typically it's better for risk assets. Could be inflationary, right? Gold could make some big moves. And if they're drastically reducing their balance sheet or hiking interest rates, that could be very bullish for the dollar and very bearish for things like stocks. We get really interesting once we get into June. June is the first one where the market is saying, oh, okay, we're going to see a rate cut by June, right? Almost let's call it a 65% chance that we're going to have a first rate cut by the June meeting. right? We might have had 2. That's what this is showing you. So then let's go to the end of the year, the last meeting of the year. Here's where things, you can see it's really sprawled out now. We have expectations for rate cuts this year. Seems like a bulk of the projections right now are somewhere between 100 basis points or 1% and 75 basis points. That would be 3 cuts, right? Did I read that right? Seems like 2 to 4 cuts is the range that the market is kind of expecting for interest rate cuts this year. If the economic data sours more, you're likely to get closer to this side. If the economic data holds up decent, you're more likely to be over here. If inflation goes crazy, you're more likely to be over here, right? So this is really important stuff. This is ultimately one of the biggest liquidity providers to the entire system is the Fed, right? You want to talk about liquidity? You want to talk about real liquidity, not liquidity hunts or anything like that. I'm talking real liquidity, money flowing in or out of the market. It's the Federal Reserve, the ECB, the Bank of England, the Bank of Canada. These things are money machines that either turn on or turn off. They're really, really important. And so that's why we spend so much time focused on them. And gold here is suggesting some interesting stuff. Gold up 1.2% today. I just moved my stop loss, by the way. I'll drop it down to the 4-hour chart. I had to get down to the 4-hour chart to trail a stop here this morning. So what I did is we were in consolidation. Oh, that's too thick. Hold on. Boom, we broke out of there. Then we came back to the all-time high. Smashed through the all-time high. Actually, in my years of watching the price action of gold, this is a pretty crazy breakout. For other gold degenerates like myself, I would say most of the time, right? If you watch gold like I do, most of the time when you hit an all-time high, there's like some kind of falter. There's some kind of mixed reaction. But when this thing just blew through the all-time highs and said, see you later, see you never, right? And then consolidated and broke out again, this is straight up bullish, right? And no, we're not talking about inverted fair value liquidity stop hunt. I mean, if you do that, then do your thing. But here's my quick opinion on that. I'm not going to spend much time on it. My official stance after years of the kind and toxic parts of the ICT smart money concepts community, dealing with the, there's some interesting folks over there. Some are great, some are not. My opinion on it officially is it's just a framework for the same stuff that everyone else uses, and that's okay. I'm not saying it's worthless, but the ICT, the smart money concept stuff, if you want to look up like Richard Wyckoff, I studied him, oh my gosh, like maybe 10 years ago. I studied his stuff in depth. A lot of the same concepts of like liquidity sweeps or whatever. You can pull up like the Wyckoff spring. You can look up these things. These concepts are not new. They're ancient, okay? Since trading started, a lot of these same concepts are applicable. Now, if you like the terminology and the framing and the way that ICT, smart money concept stuff gives you a framework for the markets, I'll give you a big thumbs up. I got no problem for people who say, look, I like the terminology, I like the vocabulary, I like the way it's framed, it makes more sense to me. Then awesome. I'm not one of those toxic people that just says, here's the two extremes. Toxicity on this side of things is when they say, oh, we're the smart money and everybody else is stupid retail and you can't make money doing anything else. That's just foolish. But what's equally foolish is just saying that nobody could possibly make any money with this stuff, right? People are probably there's some people out there who are doing fine with it, right? Not nearly as much as they would claim, in my opinion, but that's my take on it. Like if you enjoy that framework, if you like, great. But I don't think you're doing anything that's not just rebranded content. And that's okay. Like, there's nothing wrong with rebranding content in a new framework, but claiming it to be like a superior trade like the banks, like, oh, mystical, magical system. Nah, that's completely nonsense. There's not one algorithm that runs the market. There are millions of algorithms actually running in the markets, led by hedge funds that build high frequency trading systems and that track order flow, right? They're front running the all sorts of stuff that goes on. There's so many algorithms in the market. Yeah. Anyways, gold up 1%. Stocks here just opened up. Actually lower here. NASDAQ pushing lower here on the 15-minute chart. Take a look at this. Here's your US New York Open. Big flush to the downside here. Let's see if it, I mean, the thing is with this market right now, the expected daily move is still pretty high. You've got a VIX up here today at 21.67. So you're still expected to get some sharp volatility. And I want to come back to this because this has been something that's been hot on my watch list here. I talked about it a lot yesterday. Look, I'm already long gold. I'm trailing stops. There's not too much more for me to do on gold. But for stocks, for indices, I am very interested in looking for price action to follow through, right? So you had 2 days up, right? Let's take a look at the price action, right? Price action for the S&P 500, or we could do NASDAQ. Let's do NASDAQ because NASDAQ is more fun. NASDAQ, wicks on the bottom, 1-2 days up. Nice. Okay, that's a good start, but sellers are still in control of this market. On a technical basis, what I am and have been looking for is follow through, right? I'm going to get rid of this trend line. Keep it really simple. We broke really key levels of support. As soon as these levels started breaking, it's just been waterfall effect, right? Selling, selling, selling. We could just waterfall through the lows again. Like, that's totally possible. I actually hope from a long-term perspective that that does happen because I could get some stocks at cheaper prices. But from a technical basis for long setups, I mentioned that what I am still waiting for is this kind of move, a break to reverse some of this bearish structure that the market has been putting in here, right? We've been failing at support levels. We want to start to see, at least the way I want to see it form, I want to start to see resistance failing, right? Support has been failing. This is what we talk about a lot in terms of price action, keeping it really simple. We don't use anything fancy. Like I said, I'm not a big fan of the, liquidity sweeps and fair value gaps. I'm personally not a big fan of that stuff. I find it to be overcomplicating what should be really kept simple. We have key levels of support, right? Resistance. Let's see those levels start to break with some momentum. And in my opinion, more importantly, do the fundamentals make sense? Last week, we had some good data. Inflation data cooled, and I actually think that the risk to reward on stocks looks quite good. What's keeping me back on the score, which I've been talking about here, let's filter for indices just so we can keep our radar here tight, is trend, right? The momentum here is still in favor of the sellers. That's kept me out of the way of getting involved in the indices. But seasonality looks okay. Retail positioning, very bearish. That's a contrarian bullish signal. COT data, we saw institutional money buying the dip last week. Very interesting, right? We could track that through the COT data. Then we take a look at inflation data. Came in really good last week. You had softer PPI, softer CPI, right? Softer as in cooler inflation data, less inflation than what was feared. So I put all that together and I say, look, if there is a technical breakout for the S&P and the NASDAQ, I will be buying that. But we're not quite getting it, and price action's not cooperating yet. So, I mean, NASDAQ's down 1.3%. I would say that's still within the range that we kind of expect right now. I'll show you that. We could, here's a little fancy average true range. Let's get our average true range. And let's just use a 7 so we can kind of take a look at this recent period. What are we expecting in terms of daily movement? So the average true range, I'm going to change this color so you guys hopefully can see it a little bit better on your screens. Okay, So the average true range just tells you in the last seven days or whatever your selected period. I've selected 7. No magic, no crystal balls, just simple stuff. In the last 7 days, on average, we're seeing about a 500 point move. So let's just take that. Okay, is today's move within 500 points? Yes. 500, greater than 500 would be down to here. So if you get something like this today, then that's concerning. That's acceleration to the downside. But anything before this is just normal, expected probability, expected move for the day. Okay. So I'm not freaking out about a 1.4% drop. Now, over here, yes, I would be freaking out about 1.4% move, or not freaking out, but I'd be more taking that seriously because the expected move back here was 250 points. So, you want to keep in mind ATR, average true range, is a really cool indicator for this. You can say, is this move today expected kind of movement or unexpected, more violent movement than anticipated? Gold, just off its highs here. Take a look at the 1 hour chart. So I have my stop loss. So just before I move on to gold for a second, let me just kind of finish out my thought. NASDAQ, like I said, I want to see the lows get held here intraday. I'd like to see breakouts here. If you start to see this price action, constructive, working through these resistance points, I would personally be looking for longs. So I like that setup on the NASDAQ quite a bit, and the S&P 500, I like both. But you're seeing a little bit of pushback here from sellers. So I don't have a position on the NAS or the S&P, but actively looking. Okay, so that is NASDAQ S&P. Let's move on. Let's take a look at gold. Like I said earlier, I do still have a position on this one, and I actually trailed my stop loss. I'm going to sneeze. Hold on. On the 4 hour chart, I trailed my stop loss. We had this consolidation. Boom, breakout again, another push higher. This is great. I am going to also talk about a couple trades that are not going my way right now as well. So I know I'm kind of talking about gold here. It's gone quite well. I do have some positions that are not going as well that I'll talk about. Thank you. Appreciate you. Yeah. So again, another breakout. Stop loss, I put it right below this consolidation. Like if we come back and test this area, perfectly fine. What I'd not be okay with, would we come down, test this area where bulls consolidated and pushed higher, and we just fail there. Like that's time to get out of the trade. I'll just take my profits. Again, I've been in the trade for, man, how long have I been in this trade? I've been in this trade for 15 days. So, this is why I love swing trading personally, is because I can catch a good move like this, and for one action, right, 15 days of overall gains. I mean, I had to sit through this for a little while, but that's why I love swing trading. Is I'm not making 75 decisions per day. This was, I did my analysis that day. Price came down to that level, nice rip off the lows, and I went long. Stops below structure. I've trailed stops to here, and then I've trailed stops to here. No, I'm sorry. I had my initial stop here. We consolidated, pushed through. Once we broke those highs, I trailed my stop here. And then today, I trailed my stop just below that 4 hour chart consolidation. So minimal work, and I'm floating a pretty good trade here. I think the P&L is somewhere in the 20s, which is awesome, 20K. So I'm going to continue to trail stops on it. And as long as it keeps making higher highs, higher lows, I'll trail the stop further and further. See how far we can go with it. Okay, so let's just take a quick look at the dollar index as well. Dollar index sitting at consolidation. My perspective on the dollar is that I would not be surprised if we pulled back, but I think the bigger picture for the dollar is still lower. Part of the reason for that is when we take a look at our economic heat map, take a look at the US economic heat map, you can see that most of our factors here are suggesting bearishness for the US dollar. Check out the new feature. If you are an Edgefinder user, highly recommended you check this out on your own end. And what we've got here is our US dollar impact, or our stocks impact. I know there's a lot of people who watch my videos or who are Edgefinder supporters and customers who trade stocks or indices, and there's other people who trade gold, currencies, and dollars, right? So we have two columns now, one a little bit more fixated towards stock biases. And a quick example would be inflation data cooled last week. So we had some confusion about this. People said, Nick, if inflation cooled, how is that good for the dollar? And the answer is it's not good for the dollar, right? So the way we broke this down is this is good for the economy. Inflation is good. Inflation cooling is good, right? That's a good thing for the economy. It's not good for the dollar, right? So dollar, we've in the impact column shows you that this data, PPI and CPI coming in softer than expected or cool data, right? Slowing inflation, bearish for the US dollar, but that's bullish for stocks. Those are great. That's great news for stocks, right? So we want to understand that discrepancy. And I know a lot of traders who are trying to get into fundamentals, they've expressed that this way of displaying it makes it a little bit more approachable, a little easier to understand the economic data, the surprise that it came in as, the actual forecast previous, and the impact on the US dollar, the impact on stock indices. Hopefully that helps, but that is kind of our mission with this page, is to make it as easily, I thought about this is basically a way more advanced and kind of useful version of Forex Factory. It shows you all the data, but it actually shows you the impact, and not just one thing at a time. It shows you all of the key metrics and their conglomerate or their aggregate impact on key things like the US dollar and stock indices. By the way, we are giving away a free copy of the Edgefinder this week. Here's how you can enter for a chance to win. It is completely free to join for a chance. Join the Telegram. We'll drop the link here in the chat. It takes 2 seconds. We put bonus videos and content out there. So if you're a real fan of the show, make sure to keep up with us in the Telegram. We'll drop the link to the Telegram channel. Here it is. Boom. Step number 1, join the free Telegram channel for a chance to win a copy of the Edgefinder. And step 2, we'll be dropping some info on how you can join that giveaway and put your name in the hat for a chance to win shortly. So there you go. Okay, guys, up next, we've got Alan Perez taking over the stream for a little bit, going over some of his favorite charts and things he's looking at in the markets. So we'll be right back with Alan after this. Remember, like I said, make sure to join that giveaway if you have not already. All the information is in the chat. Okay, up next, we got Alan Perez just after this.
2025 is here, and to kick off your new year of trading, you can get access to our free A1 Trading Telegram channel. Inside, we share Edgefinder data, free trading courses, market forecasts written by our in-house traders, and free trade ideas on Forex, indices, gold, and more. And if you're more into the stock trading world, we have a whole Telegram channel dedicated to just that. Start your new year off right by joining the A1 Trading Telegram channels completely free. Links can be found in the description and in the live chat. Now, back to the show.
Good morning, everybody, or good afternoon, wherever you are. Happy Tuesday. Hope everyone's doing good. Hope everyone's trading safely here with this volatile week that we had before us here. We have the stock market down 1%, the NASDAQ over here down 1.6%. And I think we're in an interesting spot. This is something I wanted to go over my weekly outlook that I'm going to be publishing a little bit later. But the stock market here has gotten a little bit of a rebound. Now, I don't want to be too bullish on the stock market because we do have important data coming out that could influence that. We have the dot plot and other central banks are coming out with their interest rate decisions, like the Bank of Japan and the Swiss. But I do think that we are in an interesting level. We have 2 days of solid bullish candles closing. Now, right now we are in the red about 1%, but I want to see how this closes. And for reference here, I want to also look at the VIX. The VIX has been seeing a little bit of a fade away, and usually when that happens, the stock market is expecting a little bit more organic, not that much impulsive moves. And so we see the VIX kind of settle down. I know yesterday we were at the 20 handle here a little bit, but if we stay in this zone here, I do think that the stock market can rebound a little bit. Last week and the week prior to that, for the last about 20 days or so, by noon, every bullish movement on the stock market got faded back down. And so these last 2 days, we didn't see that, which is, a good sign that maybe we are getting some bottoming on the stock market and that we could see some bullish momentum there. Now, I don't trade the stock market actively, like as far as a trading perspective. That's more like of a long-term thing. But I do think that a bottom pattern could happen. And, if I were, in the position to trade this market, I would see that as one of my top three optimistic plays that I would look for to take advantage of. Another thing I don't trade is gold. And if we just look at gold here, it is moving. I think buying this market, at this market price here where we're at 3,035, could be a little bit dangerous. I'm not bearish against gold, but if you're buying here, you have all this to the downside against you. And then as far as take profit goes, you don't really have anything to reference. So the safest way I would approach gold would be to just wait for some healthy pullbacks, maybe something like this here. But in a market like this that's moving so strongly, usually there's brief pullbacks, and then those brief pullbacks get bought into. So that's the kind of thing with gold. If I were to trade it, I'd be extremely patient. I know that a lot of the retail crowd, we see this bullish momentum and you want to jump right in. But we just have to remember from a risk to reward perspective that if you hop in right here and the next, I guess, best target would be something like this, well, you have all this downside that you have to look out for. So that's how I would approach gold. Those are like my top three here. One thing that I would like to look over is the euro. Now, I'm a currency trader, and that's what I trade primarily, G10 currencies. And so the euro, or the anti-dollar, however you want to call it, is something that I trade most often. And so an opportunity for me would be, ideally, I like to get a pullback maybe to here or maybe to here. But like I mentioned with gold, like this euro took off almost 500 pips or so when the European government said that they wanted to commit about 500 to 800 billion dollars to their military spending. And what that can do, and what the market saw, is more participation for the European economy. It could create some growth, some more jobs, and it makes the European economy more military independent. Whereas right now, a lot of the countries are dependent on the U.S. just because we're such a powerhouse. And so that really lifted the euro about 500 pips. And, we see that we're kind of just flirting around this level. Similar, if you look at the dollar chart here, it's basically the same thing, just inversed. And so I want to see how we react, because I was listening to Nick earlier. We do have the dot plot coming out for the Fed, which could change the trajectory for how interest rates are perceived. So I want to see if there's going to be more of like a little brief pullback, or if we're going to see just straight up buying. And if we were to do that, then I would look for a zone like the 112 or the 110 area like this. Because if we all zoom out here, we're pretty much in this big range. And that's the cool thing about currencies, is that when price gets to these levels, at the bottom or tops of the ranges, then you have so much opportunity, for the, to target the opposite side. Now that takes a while to develop sometimes, but the cool thing is that we could have an opportunity to get back to this level. And then, obviously we'd have to see what's going on in the macro to see if we are going to break this level, or if we're just going to bounce right off of that. So that's what I'm looking at. If we're looking at the edge finder here, I like the euro Australian dollar. That one's a very bullish reading for me. But if we look at the chart, it's pretty hard to trade, in my opinion, just because I don't like this level here. Like, I wouldn't know where to, really buy into. Ideally, I would like something like this. For the euro Australian dollar, if we continue seeing the bullish momentum for the euro, the military spending is definitely on the table. And if we do see the dot plot for the US start to say that, interest rates are going to come down a little bit faster, or just confirming that they are going to come down, that could go ahead and propel the euro. And if we do see that happen, I could see that the euro Australian dollar is going to go ahead and continue appreciating. And if we look left for target areas, you have all of this here to target here in this zone. Now, are we going to get all the way to the here? Uh, Probably not anytime soon, but you do have levels. If you just look left, you have right here, I could see right here. Those are areas that I would target on the euro, especially also, guys, if we consider the Australian dollar and the New Zealand dollar too. Those currencies have been getting beat up more than the counterparts like euro or the pound. If we just look at the Australian dollar, we're at a zone here, a previous resistance that once was support and that has now turned resistance. If we do see the Australian dollar kind of just bounce off of here, or just not break this level, while we see the euro appreciating faster than the Australian dollar, then we could really see that trade take off, especially considering too that the Australian dollar is a very commodity driven currency. The price of oil affects that, and if we just look at oil here, we are also just trending downwards. So that could really help the euro Australian dollar. Good to see Bashy, Shadow, Kiddis, all the regulars here. I think I saw Lee James as well. But those are kind of what I'm looking at. I see some requests. I see, can you look at pound CAD, euro Australian dollar? Yeah. Mr. Alexander, I hope this helped you with the euro Australian dollar. Basically, if we see the euro go ahead and appreciate, we break out the zone that we're currently in and we start targeting that 110 or that 112, then I will go ahead and try to take a buy position on the euro Australian dollar. And then also, if the oil market continues to depreciate, that could also help this specific currency pair. Profit, can you show me the last 3 trades? You close either profit or loss? Absolutely, I can. So this one, I'll show you. It was 2 losses and one that's still up in the air. Those are my last 3 here. The euro dollar, at this time, we were at this zone here. And I was at the time going very bearish the euro and very bullish the dollar. And the market general consensus was that the euro dollar is going to go ahead and hit parity. And so we got pretty close. Profit pathways. We were hitting this level here. And so when we approached this level, I thought, okay, we can go ahead and probably get a rejection. But then that's when the European economy or the European government said that they wanted to spend 500 to 800 billion euros on military spending. And so that pretty quickly took me out for a loss. And then so now, as the fundamental shift or the landscape changes, you have to go ahead and repivot. Now, another one that I was in was the dollar Swiss. So basically, those are very heavily correlated. When that was happening, I was also under the impression that we could go ahead and bounce off of this zone. I got in whenever I saw this, this hammer candle close into the zone, and I was going to expect that the dollar Swiss go ahead and appreciate as my euro trade went ahead and appreciated. So those are 2 of the trades. And then lastly, one trade that I'm currently in that I'm in drawdown was the Swiss yen here. I entered right here, and as of yesterday, we kind of are in some drawdown here. If we go ahead and take out these highs, or this high right here, then I'll probably get stopped out. Longer term, though, I don't mind being in drawdown on this trade because the Bank of Japan wants to actively hike rates, while the Swiss bank wants to go ahead and go to a neutral rate at 0. And what's going to be interesting this week is that on the 18th, which is actually today, around 10 p.m., the Bank of Japan is going to go ahead, and the expectation is that they're going to hold rates. But the context that the market is looking for is whether that rate hold is a hawkish or dovish rate hold. If they say somewhere that they want to, that they are still interested in hiking the rate and eventually going, just hike more, then that could go ahead and cause the Swiss yen or any yen pair to go ahead and depreciate as the yen takes off on that. Also, to the Swiss yen, um, these two are currently at a half a basis point as far as their interest rate. So if the Swiss goes ahead and lowers their rate while the yen goes ahead and hikes their rate, then you can get a positive swap on this trade. New Zealand CAD. Profit pathways. Those are my last 3 trades as you requested. 2 losers and one that's just sitting in drawdown here. Andre, pound dollar to 128. Pound dollar. So yeah, I actually have this zone marked out. Ideally, that would be a lovely pullback. If we get into this zone, and the landscape is pretty much the same as we are now, where we're seeing more of a dollar bearish, sentiment, then absolutely I would love to see a buy here. Now, Andre, are you asking if you are going to short into this level or if you're trying to buy into this level? Because I asked that because right now the momentum is pretty strong. And so usually when momentum is pretty, heavy in one direction, any brief little pullback can get bought into. And so that's why it could be a little bit difficult to kind of go against the grain and short into this 128 level. Now, I'm not saying that 128 level is a bad zone. I actually love that zone. I think we could both or all agree on that. But it could be a little bit dangerous if we're shorting, going against the grain. I think the safest way to do it, honestly, Andre, would be to just wait and get this, approach this zone. And then we could look for longs. We could go ahead and target maybe something like this. If we're just looking at previous highs, I know, earlier in the year, the 132 handle was a good zone that a lot of the market was eyeing. And then we could go ahead and just maybe if you want to do a tight stop at 132 pips, or if you want to just go ahead and get out if we, breach this swing low here. So that's how I would approach it. Andre, yeah, so buy at 128 and target the 131, the 31.5. I think that's a really good trade. If we kind of get that, and the dot plot says that the dollar is going to go ahead and they want to lower rates, and that's what everyone wants, but it's just lowering them when it's appropriate is what we have to look for. So yeah, if we hit this zone here, and all those things, all the macros still aligned, if the edge finder is still showing us that yes, we are still bullish, euro dollar, pound dollar, things of that nature, then I think that is a very good setup that we could all kind of go for. Euro New Zealand is going to be similar. I'm going to assume like the Euro Australian. Let's see here. These are very old zones that I have. Technically, I would look for something like this. I actually like the price action on the Euro New Zealand better than the Euro Australian. I look for something like this. We see that we have, this little inefficiency here. You can call it whatever you want, a fair value gap, a gap, or a breakaway gap. It's all really the same thing. That would be a really good zone, actually. Now, I would hope that we can get some continued selling for the euro that could cause this to go down. But I think that is a very good buy entry zone. Again, if the fundamentals and the macro still favors for a stronger euro and things of that nature. ICT Allen, absolutely no way. No, I mean, I think like some of the concepts are really nice, or not nice, but I think they can work. But in my opinion, a lot of the terms are just renamed terms that have been around for a while, like a fair value gap. It's just a gap, in my opinion. New Zealand CAD. New Zealand CAD, I don't know. I think that, well, let me check the edge finder to see if that's even a thing. I think I just saw it neutral. Hmm, I don't know. It could be a neutral reading here. Yeah, when I think of New Zealand CAD, I think those are both vulnerable currencies. Similar to the Australian dollar, the New Zealand dollar fundamentally is very much affected by oil prices. So if already anticipating a weaker Australian dollar, a weaker New Zealand dollar, um, shorting the New Zealand dollar could work. But also, the Canadian dollar is also very vulnerable, especially right now with the tariffs, and they're being targeted. Specifically, they're always making headlines that Canada and Mexico are going to get hit the hardest with tariffs. So those are two weaker currencies that I think could be really hard to trade. Because when we're trading the markets, especially currencies, the cool thing is that you're trading one thing against the other. So for the best setup, the best opportunity is to find something that's really strong and then find something that's very weak and then trade those against each other. Um, so that is, in my opinion, this would be really hard for me to trade, and I think I'd probably stay away with it from it. Did I touch dollar yen? Yeah, I had some success with dollar yen as we were trading down here. Now we see here that this previous support got broken, and now we are retesting it. If the yen goes, or the Bank of Japan goes ahead and comes out with a rate hold that is hawkish, then I think we could go ahead and see some more retracement back down to this level, and then this support could now officially become some resistance. That's what I'm looking at. Um, Holding it overnight is a little bit tricky just because of the swap rate. It's pretty hefty, it's 4%. So um, this will be more of an intraday play. But these yen pairs are really volatile, so it's not uncommon for you to get a quick 200 pip move in a day. You're welcome, Habib. Hello, everyone. Gold, man, I wish I traded gold. Honestly, I really wish I traded gold. It is just moving. It's a really nice pair to trade. Let me go ahead and remove these drawings here for you guys. I'll kind of go over it earlier, like what I said earlier. Gold has already moved so much, and if you're buying this thing, you're buying it at a premium. So the safest way to do it, in my opinion, is just wait for a decent retracement back into a zone that's respected. If you don't, then let's say you buy right here at this market price, you have, and the next zone on the higher time frame that's been respected is all the way over here. You have all of this downside risk, and then you really don't have a target to aim for. What, when gold kind of reaches all-time highs, or any asset reaches all-time highs, and there's no past tops or targets, it's really hard. You kind of have to just trail stops and let it take you out. So that's how I would approach gold. NASDAQ, Carlos Perez, thank you so much. Guys, my dad, if you guys watch my intro video on my YouTube channel, I spoke about my dad. Now, my dad is visiting me in Chicago. He is in another room right now. But if we could all say hello to Mr. Carlos Perez, he is the GOAT. Let's show him some love, please. He's a really good guy. Love the guy to death. Let's show him that we appreciate him. Alan, señor. Nasdaq is pretty similar to the S&P. Now, where the Nasdaq is a little bit more volatile than the S&P, and we are seeing a reaction to this zone. I want to see how we are going to close the day. If we go ahead and close bullish like this, or even more, then that could be a little bit of a signal that we could just be making lower highs. How do I use the COT data? It's so important. The COT data, you can get it many different ways. You can get it from the actual website. It's really hard to digest, though. One thing I really appreciate about the Edge Finder here is it consolidates all of the relevant data, and it kind of just visualizes it in a really easy to digest visual. But how I see the COT, and my fault, guys, for mentioning this, but another bias or confluence that I have about, maybe we could be seeing a bottoming for the equity indices is our recent weekly filings for the commitment of traders. So we're seeing a lower VIX. Now, I do recognize that we are edging up a little bit here, but it all matters on how we close. But we see a lower VIX stabilizing. And then we also see that the S&P was the most bought asset last week out of everything that you could buy. Net change of 3.82%. What I like to see here, and what's really interesting to me, is that 35, if we're just looking at the number here, minus 35,000 long or short contracts were removed. So that is short pressure from the market that was relieved. And then, 14,584 long contracts. Those are contracts that people bought in and stepped in on that. Now, what's a little bit contradicting is this US dollar and the euro. Those were both pretty much bought out evenly, and their net positioning is almost the same. You have 16,835 for the euro, and you have or for the dollar, I'm sorry, and the euro's at 13,090. So if we look at the price action, that could also justify why we're just hanging out in this level. When the net positionings are pretty much the same, that's when you see ranges and consolidations. And so I think the market's really going to be paying attention for the dot plot. Honestly, that's what I'm looking at. If we can see a break in either direction, I think that move will be with great force. US 30 sales. That's a market that's pretty interest rate sensitive. It could work. I personally don't do it. But in a bearish market, as far as for now, right, we haven't confirmed anything or not. It could work. Dim. That's what I don't understand. The euro and pound was bought proper this week. I expect more bullish continuation, but instead getting some sell-off. So Dim, yeah, it was bought, but also the dollar was bought. And as far as the euro and the dollar, their net positioning is pretty much the same. I don't know if we're getting a sell-off yet. I mean, we're pretty much still hovering over the the highs of this move here. I do see some range bound. I could definitely see some range bound motions. What do you think about the pound weakness? Excuse me. The pound, yeah, it's been getting pretty weak here. If we're looking at, sorry, this chart looks very ugly, guys. Bear with me. Let me go ahead and fix this. Yeah, the yen is trending upwards, so it's getting weakness in the short term, and that's why I'm not really freaking out or ditching my Swiss yen position. We're reacting off of the zone, momentum wise. We are in bullish momentum, so I wouldn't really say pound weakness is upon us. I think that the market is just waiting for that Bank of Japan interest rate decision. Now, this low here, if let's say we break this low, then we could go ahead and, maybe we could kind of start to worry about our Swiss yen positions or our yen positioning. But until then, until the trend isn't validated, That's the hard part about markets, right? Let's say you got in at a bad price, but that's more of a personal problem, not the market problem. If you got in at a bad price, let's say right here, but the trend is still valid. The tough part about it is that you have to kind of sit through that until the trend is actually validated. And so that's why I say, be careful when you're trading gold. Don't get in at a bad price, because if you get in at a good price, then this doesn't bother you. You're pretty much at break even or pretty much close to break even. GU analysis, I will do so. I'll look at GU for United, and then I'll go ahead and look at the EuroCAD. I think EuroCAD would be a good one. I know that the Canadian dollar has been getting a little bit beat up here. The euro has seen some appreciation, so just off of the top of my head, that could be a good play. We'll just have to see if technically that makes sense. For the pound, if you weren't here earlier, who was it? United. Then I'm looking for this 1.2800 level. I'm going to be patient. I don't really feel comfortable just buying this market, even though we have the momentum. And if you just look at a momentum indicator like the Ichimoku cloud or whatever, this is something that indicates strong momentum in the markets. Just because it's green here doesn't mean that you can just buy this market if the closest level is going to be something like this. Because if you get here and we just target this level, then you have all this downside risk, right? And that's just if the trend continues in the direction. Let's say we approach this level and we start changing directions. Well, now in reality, you have all of this downside risk potentially, right? If we're just referencing this nearest swing high or low. So that's what I would look for the pound dollar. What's my favorite pair to trade in the 1 hour time frame? I would say the euro dollar. Euro dollar is my favorite trade. But guys, we have Chris Pulver coming on here. You guys are in good hands. I'm curious to see what his take on the equity market is and seeing if we are just see his opinions on that. But pleasure being here, guys. We'll see you guys next Tuesday. Have a good one. Bye-bye.
Hey everybody, thanks for tuning in to today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat. You can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show. Good morning, everybody. How are we doing? Happy Tuesday. Welcome back. Taking a look at everything this morning, we have a slight gap down. We are pushing a little bit lower pre-market. We have some red in the day. So SPX down just over 1%, SPY down 1.12, NDX down 1.8, Q's down 1.84. Taking it a little harder today. Mag 7's leading the way again. Tesla's down pretty big, another like 10, 15, 20 bucks on Tesla. Dow is down 0.5. Russell's down over 1%. Volatility index. Let's take a look at the 30-day VIX right here. We're at 22.19 off the recent lows at 20. One thing I was looking at here for the last, I don't know, couple of years would be all of our declines. So when we have this elevated VIX, when does it go down? Elevated VIX, when does it go down? Elevated VIX, when does it go down? And it varies, but we have anywhere between about 4 days to 14 days of VIX that's retreating. Now, That doesn't always have to happen. We could have a reason for the market to get a little bit more excited to the downside and the VIX elevates once again. But one thing I will say on the market right now is take a look at this resistance. It's not impossible to see that when we started this high and you connected the dots, that we hit resistance yesterday. So the bears have at least taken a bit of control in the short term. Part of me is a little bit happy to see, I mean, not super happy, make that clear. But part of me is a little bit happy to see that pre-Fed, the market is not already sitting at the pullback levels that I'm going after. So if we go to SPX, for example, this low right here is a pretty good pullback zone. Okay. This gap and these support levels here is a pretty good pullback zone. So I think the important thing for these next couple of days or even getting through the price action this week in the near term is if you take this down to a 1 hour chart, look, the bears have clearly clawed down to some pretty ugly corrections, right? We had a 10+% correction in the S&P, a 13 to 14% correction in the NASDAQ. It kind of rivaled what we saw back in August with that little, sell off from the weekend. It was like August 2nd through the 5th. It was it was August 2nd through 5th. It was a Friday through Monday, but it was really the Thursday to Monday was when things got really crazy over the weekend. Anyway, point is, I don't think this low is necessarily in, nor do I think this low is necessarily safe. But I think at least in the near term, with some of the extremes we've seen in sentiment readings, there's at least a bit of defense in here where the bears aren't clawing as hard and as aggressively. This short-term relief rally certainly felt pretty good. I just think that coming into the Fed on Wednesday, look, the Fed isn't going to cut rates in March. It's not an emergency cut. I don't think that their plan for 2025 would be to do anything that's emergency. I think the Fed is still planning on cutting this year. I think we'll see that in Powell's comments, whether it's explicit or not. But the data is pointing that inflation is improving. The watch tool still shows and suggests there's going to be 2 to 3 cuts this year. So right now, I mean, I'm sure my boy Charlie Bolello's probably like, tomorrow's news today, Fed's going to pause. Well, obviously, a 99% probability it's probably the case. But you go to what are they doing in May? Right now, May is an 80.5% probability that they remain paused. So unless they say something tomorrow that shifts this probability earlier, maybe they cut in May. Now, what does the market do to that to respond with it? I don't know, right? But right now it's forecasted for a June cut and then a September cut. And what's interesting is I don't see a third cut on the horizon except into 2026. So right now this is forecasting 2 cuts through the rest of the year. Could that change? Yep. All this can change. I took a screenshot of this and we'll compare this again on Wednesday. So if I go to the Fed watch tool on the 11th, so March 11th, 11:14 a.m. Well, this is different. CPI, PPI changed. Nope, it changed a little bit, but now we have more of a pause going into May. This is 53.9% for May, and currently shows 80.5. So that pause is more sustained. Again, does that change this week with the commentary on Wednesday? Maybe. But price action wise, expect there to be some noise at these lows. Listen to a couple interesting macro podcasts yesterday, and look, I think the biggest concern is that we are seeing a pretty aggressive rotation out of the U.S. right now, and here is evidence of that. I pulled this from Praetorian Capital, which is Harris Kupperman. I followed him for a little bit. I don't even know what kind of investor you'd call him. He's just very non-correlated. He's just like a deep value investor. But he is in like a bunch of non-US and mostly commodities. He's been in the energy space, uranium for a while. But I'll just show you this image. This is a bunch of non-US assets. A Poland ETF is up 36% year to date. Austria ETF up 25.7 year to date. China large cap ETF, that's FXI. That's been a stock I've been in, or an ETF I've been in since last year. Had a big rip in September and still following through up 23% year to date. We've got Greece, Spain, Germany, Colombia, Chile, Italy, Sweden, Finland, all 20+% year to date. So does that mean I want to rush in and just buy all this stuff? I mean, no, not really, but um, I'm interested. Like, how do these pay out? What's the liquidity? So basically, with the falling dollar, a lot of this money, with a rising euro, strengthening euro, falling dollar, a lot of this money is being repatriated back into their own economies, right? Like there is a move right now with Trump in office. There is a move to be more nationalistic and bring money back home. The dollar has been, if you've ever read the milkshake theory, when the dollar gets stronger, it sucks up all of the global liquidity and everything goes and feeds the dollar and it feeds the US market. And right now there is this like really interesting shift where the US market is seeing some pretty severe outflows. It's still one of the biggest markets, but it's just money that's been treated poorly outside the US is now have an opportunity to claw back. Now, full disclosure, this type of move, it hasn't happened in like a decade, you know? So I mean, this is not like you can do this every single year and see these amazing gains. Like this is a unique opportunity to trade non-US. And so I am looking at adding some exposure to my portfolio with a couple of these ETFs. I don't love them, okay? But I do think that if this is where money is flowing, I think it's worth having a basket exposure to it. Okay. So there's ways to do it. I did add a couple of other stocks to my watch list. So we have some trades here. This is a portfolio. This is a Europe portfolio. This is a Europe ETF. This is a Vanguard European ETF. And again, you can see like where are we at? We're close to these highs for the year. Are these expensive? Not really. Right? Here's iShares. There's an MSCI Europe ETF, again, near all-time highs. So I don't expect this to be just gangbusters, but if we're going up, at least we're at all-time highs as opposed to being down like we are in the S&P and the NASDAQ. Here's a total international stock market, which might be one of my favorites just because it's not just Europe. Europe is spending for defense, and that's great to see that money is being spent within the Eurozone, but just spending on defense is not really a value multiplier, right? I mean, you get like no bang for your buck when you're spending on defense, as opposed to if you're investing in infrastructure, if you're investing in AI, if you're investing in the future. Right now, that doesn't seem to be what Europe is investing in. So I'm a little cautious on what I'm willing to throw at it. But a total international stock that would have some India exposure, some Latin America exposure, some Europe exposure, some China exposure, this is what I'd like. So I'm going to do some more digging on some of these ETFs, and I'll find a couple that I'll probably allocate to. But I might throw like a 3%, 3 to 5% in. I treat this a lot like allocating to bonds. I do have a little exposure in TLT. I have exposure in gold. I have exposure in silver. Got some exposure in Bitcoin. So I look at this as an allocation, as a typical diversifier. Get away from US, non-US, or get away from US and get some exposure in non-US, and try to do it in a pretty low cost basis, and something I can either dollar cost average into or sell some options on it, or trade some options on it, and see how 2025 performs. Also, sector wise, we talked about this, but sector wise, year to date, S&P is down 3.5%. Consumer discretionary getting hit the hardest. Energy is still up. Healthcare is still up. Utility still up. These are sectors that I'd be looking to follow in 2025. This doesn't mean these are going to be winning sectors, however. Let's make that very clear. If we are in a pretty nasty market and the U.S. indexes are down as a whole, you can have a diversifier. You can have some non-correlation, but it doesn't mean that if you trade into 2022, everything was down. Okay. The only thing I made money in 2022 was currencies and Q1 and energy. That was it. Everything else was a freaking fight. So all this means is it won't suck as bad. If we're in a rough market 2025, everything is going to be down. These might just suck less. Okay. That's why I think the non-US exposure could be an interesting play for 2025. So I'll do some more deep diving today, and see if I want to start allocating. But I've got energy, I've got healthcare, and I've got some utilities, but those sectors are fine. So XLE, continuing to hang in there. I've got trades that expire at the end of the quarter. 3 puts for $1.41 per contract, and I've got that on a handful of my accounts. So it'll be a little income trade. Pfizer, this is part of my healthcare play. I've got a diagonal spread on Pfizer, and then J&J, some naked puts on this one at the 130 and 140 level. So I mean, it's cooperating nicely. I've got mostly profits on those. And then utilities, XLU, I did sell some puts on this one. I do want to see if it comes back down to a range opportunity. I'm not buying into utilities right now. This might just be, kind of a buy and hold. I mean, the ETF itself, the sector play as a 2.83% dividend, it is very low beta. So don't expect price appreciation on this one. So I mean, if it just oscillates anything in here, maybe a dollar cost average, maybe sell some premium, maybe sell some puts. Expect there to be a low beta is good. So if it just hangs out and stays stable, to me, that's good enough. That I consider that an income play and an income win this year. Okay. All right. So also added into Pulver Alerts, I started to add some buy stop levels and buy limits to some of my Swiss pairs again. I'm still holding Aussie Swiss, CAD Swiss, Euro Swiss, Pound Swiss, New Zealand Swiss. I'm out of Dollar Swiss, but I leveled back in. I've got some pending orders on my Swiss pairs. So let me go back to a daily chart here. So my profit target on staying long the Aussie Swiss, and there's bigger profit targets to me. I don't know if we're going to have, a run back into, 7,000, but eventually if we can hold this like flash crash low here, we might even come back and retest it. I'm still not done. Like this, when it's all said and done, this is going to be just a monster bottoming pattern. And one thing I'll be watching would be, let's say that we end up going back up into, I mean, my profit target set at right around 59.80. Okay. And that's like target one. But if we end up holding this low, and this is the really simple move. Let's say that we slide lower, channel, come back and retest this flash crash low from August of 2024, and then we come back into the center high. Well, that is a center high. That would be a double bottom. That would get all the way back into, let's say, 6,000. Right? So that's where my profit target is really going to be. That's where I want price to go. Am I going to have to be patient? Yep. We're going to have to see this week. The Swiss National Bank should be cutting rates on Thursday, or did they already cut last week? I think it's this week. We have FOMC pausing, Swiss National Bank on Thursday expecting to cut 25 basis points. Also, the Bank of England expecting to hold and stay at 4.5. So, all right, let's take a look at the dollar really quickly. So, dollar index. And because of this aggressive shift, if the dollar continues to weaken, one thing that may be wild and crazy, and one of the craziest trades of 2025 would be if this dollar falls into the 100 to 101 level and doesn't bounce. I think that might be my biggest. In the FX land, like that would be insane and probably unprecedented to see that the dollar started here and went all the way down here. That is even more conviction. Again, if this happens, that's even more conviction on a non-US dollar play. That's also more conviction on a non-US market play for 2025. Now, is that going to happen? I have no idea. But you take it in chunks. If you're short the dollar right now, you know where to be moving stop losses at least. If this thing blasts lower, well, guess what that looks like for gold? Probably looks good for gold, right? Gold's trading up above 3,000. I haven't really seen any major profit taking. I still see a lot of divergence on gold as well as a very high bar count. So I'm still cautious of this, daily overbought condition, the weekly as well. I mean, we're extremely overbought in the weekly with divergence. So I mean, again, and this isn't like calling a top in gold. I just think that we're going to have at least like a slow climb as price and momentum are clearly disagreeing. So prices made fresh highs, disagreement. Prices made fresh highs, hidden bearish divergence on overbought conditions on a relative strength that is hard to get to, by the way. This is a weekly chart with an RSI at 21. That is a hard level to get to overbought conditions. But it's still overbought. I still think the bar count is something to pay attention to. But I'm curious, how many pivots we have missed along the way, how long we've gone between bar counts. Last time we touched this 200 moving average was, I think, 360 bars. About 367 bars. So that was the same reason that I was bearish on Meta and Netflix and Costco and the S&P and the NASDAQ and all sorts of stocks this year. Because we had a crazy high bar count and we overstretched where the percentage away was pretty high. So I'm curious if this is a, kind of a Q1 play that then changes a little bit in April, and we just get some shifting. That's all. I still like buying the dip on gold. I just want to see if there is a dip. Okay. All right, that's gold. Let's keep going. So top down, markets are down a little bit today. A couple things coming into the Fed for Wednesday. I still think the pullback zone is right around this 5750 to 5800 zone. Like I said today, I mean, it's kind of nice to see that the market is still pretty calm pre-Fed, as opposed to just a big fat slap to the downside or just some crazy rip before the Fed even happens. So Fed matters tomorrow. We'll see what happens. I don't think the language is really going to be that important. I think it's, listen to what Powell says, but more importantly is for those 2 hours, what does price do? Price might do something, price might do nothing. Typically, Fed announcements and FOMCs and press conferences are very noisy with a kind of wide range where like highs and lows get tested, and then the markets kind of settle and do absolutely nothing. So I don't know. It could be one of those tricky days where maybe Powell says something the market likes, maybe Powell says something the market doesn't like, and there's a directional play, but I'm not sure. So I think it's wait and see. I think if the market is able to use the Fed as a reason to get back into pullback zones, that's totally fine. My concern is that by the end of the quarter, if we're not holding there, then by the end of the quarter, we're going to come back and revisit some of these levels. One key level to write down, I talked about this yesterday, 55.65 is a key level with major put volume. That is, it's hedged below that. So there could be like a slingshot effectively if it really dipped too far below it. But this tested around 5,500 here. So 55.65, I think by Q1 expiration, which is Monday the 31st, I'm pretty confident that we would likely stay above 55.65 for the end of the quarter. So what that looks like, okay, fine, take it for what it is. But I'm still looking to see if we have a bit of a repair trade to the upside towards like 57.50 to 58.50. But I would be very cautious in that zone. If we come back into that window, I would be cautious because from there it is, I don't know. To me, this is where all that resistance is sitting. All this resistance. I know my chart's a little bit busy right now, but all this resistance just from past support right in here. So that's the pullback zone. So if we go low, high, higher, low, higher, high, that's a good sign. But you can still see it faces a lot of resistance. So for me to say like the coast is clear, I think the bulls are back in control. At least it seems like it. We'd have to have a pretty sustained close above 5,900. And I mean, and the crazy part is that 5,900, we're not even that far away from all-time highs nor the lows. We're like right back in equilibrium, So we'll see what happens. But if we do get to this pullback zone, like I said, there's a couple of timing indicators that I want to share. I don't think this low is necessarily the lowest. I don't think it's the safest. If you're looking at timing the market in 2025, and this is just a guess, but history is a pretty good way of giving you some indicators and indications that this market can find some lows. If I go into my how many stocks are above the 50-day moving average, okay, there's three of them here. This is the S&P stocks above the 50-day moving average. Notice how it's not at the lows. So this is one timing indicator that I'd be watching. If you want to see market breadth and market bottom, this is a really good timing indicator over the last, 20, 30 years. So does it get there very often? No. That's the point. Is that just kind of shows like the whole market is experiencing all this pain together. That's the broadening out. And then you look to see how we can kind of buy our way through it, right? So that's one. That's the S&P 500 above the 50-day moving average. I'm looking to see if this settles back into the low teens. I've got a level here set at $10.80, and all that is just a pretty nice support zone going all the way back into as far back as I can go. Right? I can take this weekly chart all the way back to 07. Okay. Good enough for me. As far as timing, it's like we know the market's gone up and made all-time highs since 07. We know it got through a crash in 08 with a great financial crisis, but once we bottomed in September 2009 and ripped, we've had one of the greatest bull markets ever in 15 years. right? It has not been perfect, and it has not been done without hiccups. We've had hiccups along the way. So an indicator like this, if you were positioning long anywhere here, all that is doing is just juicing your gains, because that is a great timing mechanism for getting long. So this is why I think that the lows are not necessarily in, because if there's more market breadth pain, then we possibly have this pushing lower, and that becomes an opportunity to get long. What does that translate into as far as a percentage drawdown? What does that translate into as far as how far down the S&P and the Qs are? I don't know. I would imagine somewhere between maybe 15% and 20%, right? I mean, we had a bear market in 2022 that was down about 25 to 35% between the two indexes. So we could be hitting that territory. But I don't think the U.S. is an interesting podcast I listened to yesterday. I don't think the U.S. can afford to go into a recession, right? Trump comes into office. We want to be the future of crypto. We want to be the future of AI. We want to be this hub for everything. We want America to be great again, blah, blah, blah. Well, if we're going to go into recession and have to build back out of that, we're going to fall way behind. That's a massive lag compared to what the world is doing right now, because the world is taking advantage of this weakness in the U.S. China is a poster child for dollar weakness right now, and U.S. weakness. China is loving it. It is what it is. So anyway, one timing indicator. Okay. So if we pull back into, I see this at like 12 or 11, I'm probably starting to get positioned a little bit heavier on timing the market. This was another one. The stocks above the 200-day moving average on the S&P. This is another one for market breadth purposes. Have we put in, the lows? Not necessarily. Do we get, tons and tons of stocks that are now sitting below the 50-day, below the 200-day? Everything would show like, oh my gosh, that's a bear market. True. But what makes money and what is properly valued, I mean, that's just going to be like the price to earnings reset. All these stocks from price to earnings, price multiples, all these things will be reset. And this is another one where once we're down here, there's a good timing indicator. So where would I watch? Any type of test of these previous lows. Last time we had a test of this level would have been September 2022, which was the bottom in September 2022 after, an ugly 9 months of bearishness, but that was actually signaling a nice little market bottom. We've had our COVID level, which if you had the courage to buy anything during COVID, you made a ridiculous amount of money through 2020 and 2021. If you had the ability to buy through Volmageddon in 2020, this is the December slide in 2018 when the market dropped about 20%. And then in January 2019, Fed put, and what happened? Big rip to the upside for the entire year, right? Which is why I was bearish going into 2020, because I thought that was a freaking, Fed put bubble, and it was. But timing, right? Back here in 2015, this was a 2-year range where the market had about a 15 to 20% drawdown range. Highs and lows were equal. We didn't really have any gains. We didn't really have any losses. It was kind of contained within a sideways range, but that was a good timing indicator back in 2015. Before that, 2011, dip opportunity. Before that, it was the bottom, right? The bottom through 08 and 09. And this was painful. I mean, we still, like, February 09 wasn't the bottom, right? But as we got out of 08's calamity, going into 09, like we're just nailed down here. Like, this is as bad as it got. Everything was in the toilet. So anyway, couple things to watch. S&P stocks above the 50-day, S&P stocks above the 200-day, and then you can convert that to the NASDAQ as well. Here's the NASDAQ with the 50-day. Same type of timing, very similar. Together, collectively, if you want to look at just simple, index buying or ETF buying, that's a good way to look at it. And I'd feel more confident that a bottom is near, maybe not perfect, maybe not nailing it, but to me, that would be like kind of bottom is. Make sense? Okay. All right. That's that. AXP. See, I've got a 270 by 260 ratio spread. Let me take a look at this one real quick. I still got some time in this trade. AXP right here. Ratio spread for April. Okay. This could be really good if we stabilize here on AXP And I mean, I get it. Like, there's room for this thing to keep falling, but if we stabilize, at least having some type of high, low, lower high, lower low versus just a straight fall, then this trade can work out pretty nicely. A ratio spread that has a potential, $10 bonus trap. So what would be if we're greater than 260, then I just keep my $2.80 credit. But if we're between 270 and 260, for every dollar, like 269 is a dollar bonus, 268 is $2 bonus. So if we're trading in the 260s, then I've got a bonus trap on there, but this is not until April, May. So I've got a little bit of time in this one. All right, what else? Sectors, currencies. Let's just check gold, silver, Bitcoin really quickly. I did the dollar. I think the dollar still slides a little bit lower. Watch that 101 to 100 zone. So here's the dollar index. Let's go back to the daily time frame. I mean, nothing really looks awesome on the dollar. To me, this is a bear flag or a pullback that gets faded. I just wouldn't be surprised. I mean, with this thing unraveling, we may not have a pullback at all. This thing just might slide, flag, and then slide lower. So if you are short the dollar, I did take profit yesterday on my New Zealand dollar position. Dollar exposure wise, I don't really have anything. I'm out of dollar Swiss. I'm out of dollar CAD. I close out of Aussie dollar for profit. I close out of New Zealand dollar for profit. That's it. I don't have any dollar exposure. I'm not in euro dollar. I'm not in pound dollar. All I'm in is Swiss pairs right now. JPY pairs. I'm only in FXY, which is shares. It's an ETF for the Japanese yen. And I am out of futures right now. So dollar positioning, we had that big drop in the dollar. Has this brought the 10-year lower? This is the one thing that has been interesting. The dollar's been dropping. The 10-year has not. So we had a bit of a relief, right? From the highs around 4.8 down to 4.1. We're down about 50 basis points from this high, right? Even with an improvement in inflation data, this hasn't changed. Part of that is because global yields are still elevated, right? Japanese yields are up. So this is partly why the U.S. 10-year yield has been sticky. This is a pain point for a lot of things, business related, refi, mortgages, anything that's 5, 10, 15, 20, 30-year financing. This is a key barometer. So if this goes higher, it's not good. If this goes lower, it's better. Like, it relieves the refinancing pain or relieves the borrowing pain. But I mean, what's it going to take to get back down to here? I don't know. So I don't know if, like, all this attempt to, like, bring the market down, bring the dollar down in an attempt to bring the yields down, it may not change. So that's probably not going to be great. If the 10-year yield does not go lower, part of me thinks that this is just going to be sticky, and then global yields rise, and all of a sudden the 10-year yield is going to be back up here in 2025, and that's going to be a lot more pain. So we'll see. There are some improvements, but usually this is correlated nicely with the dollar. The dollar is weakening. We had this slide in the stock market. So unless there's another slide in the stock market to the downside, possibly this weakens, but all of a sudden all you're doing is you're ratcheting up the probabilities of a U.S. recession. Now, that being said, look, the U.S. has had recessions that we just haven't officially labeled as a recession, right? 2020, they said, was a bear market, was a recession. Well, it was until it wasn't. Then it was a K-shaped recovery, and the stock market absolutely ripped. Recessions, in the reality of the stock market, it's about a 50-50 coin toss of whether stocks go up or stocks go down. It's really a toss-up. Okay. So my point is, we can have a rolling recession, which means that certain sectors are feeling it worse than others. Case in point would be if the market is going to see a deleveraging, then tech could be in a recession. Semiconductors could be dead in the water right now until there's more of a risk appetite or CapEx spending return, something like that. But through 2022, I mean, the markets were down. We had rougher sectors, but you can't just say, like, oh, manufacturing's in a recession. Well, the U.S. doesn't really rely on manufacturing. We're a service and technology country. Manufacturing is not what we do. So anyway, I think the pain is if we had a full everything is down, everything is in recession, then yeah, that's what rivals what we saw back in 2008. But I don't know if we're going to get it. I think there's pockets of the economy that are still pretty resilient. We'll see. It's the markets. Markets do what they do. It's not easy. And especially in times like this when you're like, is there a bottom coming soon? Is the market going to go higher? In the day-to-day stuff, it's you're in the trenches, you're in the mud. But if you look out the next 3, 4, 5 years, you're probably fine. And I keep saying that. Like, if this proves to be too difficult for anybody out there, get a longer term horizon, use better risk management, and stay the course. I mean, and being an investor doesn't have to be super difficult, but I think being an investor has to be longer term. Always has to be longer term. But it can get granular, and you can get in the mud, you can get in the weeds, and it can be super disruptive, like day to day when you have some stupid flows, and it can get super frustrating, like month to month or quarter to quarter when things don't cooperate. But that's kind of timing the market, and that's really difficult to do. You know. So anyway, it is what it is. All right. Let's go to gold and silver, oil. So oil just still hanging out around the support zone. Again, I don't know. I keep saying this on oil. There's a strong support level if anybody's buying it. Um, I don't think that the current administration wants to see oil prices go up, so I think they're going to continue to drill aggressively. If this floor breaks, oil can certainly slide into the low 60s. I think we get $60. I think we get $55. If you're looking to fight the inflation game, right? If you're looking to fight inflation, especially in the U.S., driving oil prices lower could certainly help that. Oil prices lower takes away some of the energy pain, and okay, so I mean, just think of things that Trump can pat himself on the back for. If the 10-year yield drops, if the market's corrected to more fair value levels, if oil is down, egg prices are down, gas at the pump is down, all these things are like check it off the box. He'll pat himself on the back. He'll talk about it. He'll rave about it. Okay, I mean, if it's happening, so be it. Doesn't come without maybe the pain. Doesn't come without maybe a conflict or a war in the next year. I don't know how low prices get. But at the same time, it's like if this floor holds and oil prices go higher, we're right back in the same camp talking about sticky inflation. Energy prices are up, which is why you have core inflation, which is excluding energy. And you've got super core inflation, which is excluding food and energy and housing. The three most common things that every consumer feels the most. And it's like, we don't want to include that. Let's just go super core and see what's really out there. It's like, oh, that crap matters. The stuff that matters is what we're not tracking from the government level, which is also why I'm watching that Trueflation as a third party. Trueflation is, to me, a better reading for the kind of trends and flows of inflation. So, I mean, we are seeing a bit of a bounce up again, but this from September to December and then fading hard. It's like I do think that trend inflation is improving, but if this starts to go right back up, then I'll say nope, we're right back where we started. A lot of roller coaster inflation. And this just means more volatility. Doesn't mean that inflation is going to be solved. Doesn't mean that inflation is going to run rampant. It just means that we could have a roller coaster ride of more volatile inflation. That's really what it means. But if it's contained within about 2 to 4%, can the Fed operate and can the markets exist and everyone lives and it's nothing that's going to break the world? Sure, and nobody knows. There is no crystal ball. But oil prices, that's where we're at. I think that the Trump administration, between U.S. and Saudi Arabia, if they want more market share, they can exist and survive and profit with lower oil prices. But it's just a weird trade. I mean, again, if it was just defined risk, I'd say, yep, I'm just going to go buy oil. I just don't trust the narrative. I think that this thing is I think it's going to break the floor. And something tells me in 2025 that that's what's most likely coming is like something's going to break before the market kind of fixes itself. The market's down, the market's kind of uncertain. I think something breaks equities market. I think we hit those like S&P above the 200 moving average or the 50 moving average. Like we hit those areas, we get to those extremes, and it's going to feel awful. But then the market's like, oh, that's what we needed, that's what we waited for, and then boom, there's your major flows. Oil could be the same thing. Maybe the oil market breaks, right? Maybe the bond market breaks. Maybe gold runs to just the freaking moon. Who knows? So oil futures, as much as I want to take a bull call spread, I'm not going to. As much as I want to take a bear call spread, I don't know if this floor just holds. So I just don't feel like putting on a trade. I don't like it. I'm still going to stay long natural gas because natural gas is still nicely elevated. This is not a trade that's near term. I'm out to 2027 on this one. And I may get this called away if we're into 23 plus above $23 by April. Then it gets called away for $18 and I make a few dollars there. Otherwise, I just sell another call against it, and I will hopefully lower this by another 40, 50 cents for my debit, and I'll just add to my bottom line and try to turn this into a better trade. Gold, 329, up a little bit, so be it. Okay, I still think we're overextended. I think we got a high percentage move above the 200 moving average and a bar count. I'd like to see maybe a Q1 pause on gold, but I don't know. Maybe gold is that thing that just shows like, hey, everyone's rushing in with a weaker dollar, buying more gold, and that's another kind of big world position on anti-US or non-gold, or I'm sorry, non-dollar. So gold could be nuts. It's really, I mean, technically speaking, it's not a trade that I would say I want to buy right now. Just technically speaking, I don't want to buy gold. Okay. But I do want to buy any reasonable dip on gold. That's it. Like any reasonable dip, pull back to the 50 period moving average, pull back to a previous high, give me something structurally that looks like it is a, buying opportunity as opposed to just buy the high, just buy the high, just buy the high. So part of me is happy that I'm still participating in this bull market since this breakout in 2024. And that's good, establishing positions around 2,000 and now it's trading around 3,000. That's a pretty good run on gold. It actually outperformed the S&P last year with two of the most bullish years in history. Gold's like, yeah, we're gonna outperform that. Pretty impressive. Okay, silver. Happy to see that silver's also clawing back and getting to fresh highs. That's encouraging. I think silver technically, I like to see more upside if we go gold versus silver. Again, this has been a pretty good comparison range for the last couple of years. If we see, I mean, I still think that both can perform well. I keep saying this, but if the ratio stays about this level, I mean, and I don't know, like maybe silver gets the upper hand, but they both still perform well. If gold breaks and goes higher, then I mean, possibly gold gets ballistic. But so far, this has been a pretty interesting range to see this ratio play out. Bitcoin, a lot of chop on Bitcoin. Previous resistance, I think this is a very important spot. Bitcoin, if we're going to see kind of a healthy bull market on Bitcoin, we probably shouldn't see Bitcoin going too much lower than about 70K. So if I just connect the lows to this trend line out here, or even in here. Okay, and I mean, the charts are already messy, but I can see through all the indicator stuff. I could see, well, I think what's going to be important is if we have this like slow accumulation, you're going to want to see prices remain stable. If we're going to see another recharge, and again, where would that be? Maybe we have like the pain trade in the equities market, and then the big buy comes in, and Bitcoin gets a bid because of it, right? So I mean, this all could be. This is what's so difficult about timing the market is there might just be a monster buy trade, but it's what, and it's what to buy, it's how to buy. So yeah, I mean, Bitcoin is a good asset to trade. It's a diversifier. Gold and silver, good assets to trade. They're diversifiers. They're already performing well this year, so that's nice to have. Individual stocks, there's more volatility in individual stocks, but the indexes being down, 11% or so on the S&P, almost 14% of the Qs. If they have another flush lower, it's like, to what degree? Does the S&P get to 12 to 15%? Does the NASDAQ get to 15 to 20%? Is that painful enough? So as far as the Fed put or the Trump put, I think in order for the U.S. to avoid going into recession mode, we really can't go too much lower in the indexes. So this is, to me, this is bear market. This is recession. I really don't care how fast this thing bounces back. This is going to be felt from almost every investor in the world. It's going to feel like crap. And the bad part is not everybody's going to participate. The only people that are going to participate in this that are not like full-time traders and investors are going to be the passive 401k people. That's the only people that are investing. And what do they end up doing? Well, they end up dollar cost averaging through it. They have targeted funds that keep adding to it every single month with that contribution. And if the market finally makes its way to all-time highs, give this a 12-month, 24-month window, and everyone with 401ks are happy. That's why most people with 20 plus years with a 401k are millionaires. It's timing the market. It's not timing the market. And it's dollar cost averaging through every nook and cranny at a regular period, right? And I say this, and it's on things that are designed to go higher, right? S&P, you can argue for, since 1928 has been a pretty resilient index. Modern market with like 1970s options and what we have now with electronic trading and all the liquidity and all the nonsense, it's just faster cycles, but it's still kind of representing the same thing. The biggest companies in the world in the U.S. and they have they have international presence. So anyway, I'm just trying to be ready. I think this week, a couple things to watch, and then I'll let you go here in just a few minutes. But I think today is an interesting day. I mean, I looked at this 5,600 zone right here, and hopefully we start to see some market makers defending this area and pulling back into where we started the day. If we're coming into the Fed tomorrow, it would make sense that we're kind of stuck right in the middle, right? So we have off of this low to this high. I wouldn't be surprised today if we're sitting at literally 50%. So from the low to the high, look at this. Where is this at today? Where's this market at? It is sitting right at, from this low to this high, it's sitting right at 50%. I don't think this by accident. And now the market going into the Fed tomorrow has a gap to play with on the downside, as well as a gap to play with in the upside. This is what's kind of perfect and also noisy about Fed days, because this market can slide down and fill the gap and then come up here and fill the gap. I don't know. So a couple things to watch. So we'll see if this level holds today. If we hold around like 5,600 and kind of bounce, we're trading right around it. It's 5,604 right now. But I'll see if we get a little nudge and just kind of recenter for the day. But I'll be watching. Okay. All right. I think I'll let you go. I'm going to try to find myself some trades and just go through the portfolio. I've just got a handful of things written down to go back and review. I've got some, I'm going to put on some, I've got a diagonal spread on Pfizer, diagonal spread on URA. Those expire on Friday on the sell side. So I'm going to look to add in another leg to that. I'm just going to review some of the positions I have with the near-term expirations, and off we go. So, all right. Thanks, everybody. I will see you tomorrow. All right, bye.
Thanks for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. Want more from A1 Trading? Check out the links in the description below, or our website a1trading.com. We have lots of free trading tools and channels available for you. We hope you have a great rest of your day, and we'll see you tomorrow.